Hey, this is David Lee Goodman. I'm a real estate agent and property manager in the Nashville market. And today we've got something a little special today. We've got Josh Jones. He's a local lender in the area that I work with a lot. Josh, thanks for being on.
Thanks for having me.
In this segment, we talked about a few things. We talked about the looming recession. We're maybe in a recession, maybe not in a recession, but we're talking about more specifically what the interest rates are. It's November 2022, and some strategies for home buyers for how to navigate that. We also talked about the difference between this market, 2022, November 2022, and what it was looking like 6 months ago or a year ago, and the pros and cons of that situation versus this situation. Josh then goes into a product called a 2-1 buy down that primary home buyers can use, which is just, you can talk to Josh about how to do that. That was really good. And finally, we got into what our thoughts of the Nashville market, where we're sitting now versus where we've been in the past. Some of Josh's predictions and my predictions, and a view of what the investment market is looking like. Mm-hmm. I had found one of my best deals I've ever got under contract happened 2 days ago. So I thought, and I'm kind of excited about that. So be sure to watch to the very end. We'll talk about all those things because at the very end we're talking about what is going on in the investment world and why there's opportunity today versus a year ago. So for the average primary home buyer, let's just get right into what is the solution. If you are a buyer right now and interest rates are really, really high, we have the benefit of lots of houses to choose from, but now I can't afford some of those houses that I could before. And technically I could have bought them. I would say as an agent, you probably were not going to buy that house. If your limit was $600,000, we weren't looking at $600,000 houses. We were looking $500,000 houses because we needed to bid those up to $550,000. Yeah. Right. So now if we're looking at a $500,000 house, or if we're looking at a $600,000 house, we can go below asking price. So it kind of is shifting the other way. And I guess another benefit that we cannot forget about is having closing costs paid for. The out-of-pocket is so much less today than it was. Yes. What the seller is giving us today is a lot less, or a lot more than it was, a year ago. But anyway, I want to talk about one specific loan product that a lot of lenders have. Your broker. Or your company's doing this now, and that is the 2-1 buy down? Yes. All right, let's talk about what that is and what the benefit is.
So the 2-1 buy down, to me, it really, first you want to break down what are your goals. So if a person's goal right now is to have a lower payment, then, it's a benefit. I'm one of those, I'm not pushing anyone towards a permanent rate buy down right now because I do not predict interest rates will be this high in the future to come. But the way it works is, so the seller has to pay for it as well, which goes back to David's point. Sellers are paying those closing costs again, when last year you couldn't get a house without overbidding.
So what is the basic, how does a 2-1, just to start with, how does it work? What does the 2 and the 1 refer to? Okay,
so let's use simple math. Right now, if interest rates are 7%, the way it works is that first year, your interest rate will be 5%. Then the second year, that interest rate will go up to 6%. Then the third year, and then the remainder of that loan term, it'll go up to the original starting rate of 7%. Right. So it's similar to an adjustable rate mortgage without all the jumping around that it can do. Right.
So that's the huge part. So going from 7% to 5%. 5% is where I would have thought we would have been 6 months ago when we were talking about interest rates going up. I wouldn't have really worried about it. I wouldn't have freaked out about 5%. But I don't think we'd have the same effect on our market if it was just up to 5%. Right. I think the challenges of 6 months ago, even at 5%, we would have still seen bidding wars because of, in our market at least. Yeah. So the fact that we can get 5% in the first year for a primary home buyer, I think that's absolutely huge.
It's huge. I mean, because you're talking about savings. It all depends on the home price, of course, but you're talking about savings of upwards $300, $400 a month for buyers. And if you're worried about month to month right now, and some first-time home buyers, they might not have a whole lot of money that they're making, that's a huge amount of savings month to month.
So I was kind of curious about this because I just started hearing about this too when I guess sellers and builders are trying to find these solutions. But this is like a conventional loan. Like this is a Freddie Fannie backed product. It seems so unconventional and kind of, I guess it's a solution.
It's FHA and VA as well.
Yeah. It's just like has this always been a product out there, or was it developed recently?
It's always been a product, but when interest rates are at 3%, it's not even talked about. Nobody's pushing that type of.
Well, also when interest rates are at 3%, that is increasing demand, and sellers have no reason, because the seller on this has to put towards your closing costs 2% of the purchase price.
Yes.
Which is significant, and that wasn't anything that was even being discussed, 6 months ago.
It was being discussed how much are you going over 50 or 100,000.
Right. So now that's on the table, and it solves the solution of the interest rates. Now, I still have the same problem though in a year or two or three. Now it's back to what current market value is today. So if it's 7% today, so in 3 years after it goes from 5 to 6 to 7, what do you tell your clients on that?
I mean, I tell my clients the goal is that we will refinance you before that happens.
What if interest rates, why do you think interest rates will be down within that 2-year period? Or, do you think that?
I don't have a crystal ball, but I know that historically interest rates have followed inflation. You can look at a chart going back to 1970. Federal Reserve has a great tool for this where you can follow 30-year mortgage rates and look at CPI reports or inflation, and they basically move hand in hand together. And I hope, my hope is that all these rate hikes that the Federal Reserve is doing is going to get inflation under control. I believe it will. Because what they've done is unprecedented. We just had, our fourth 75 basis point hike? Before 1994, they had only done 2 75 basis point hikes in a row. Now we've done all these back to back to back. So the question is, did they do too much too fast? That's the worry.
And what I heard is that they're doing too much too fast. That brings interest rates back even lower to try to offset the damage that's being done if they're going too fast, which it feels kind of fast to me, but I work in real estate.
It does, but here's the kicker where it kills the average person. If they did move too fast, it sends us into recession. And if people don't have jobs, then they don't buy houses in that market as well. But to your point, it is good for interest rates because that's when they start using their tools to correct that.
Gotcha. So right now, like we talked about, interest rates are really, really high. Where are they at right now?
7.5%. 7. Right now we're kind of bouncing between a range of 7% to 7.5%.
And so what that means for most people is the mortgage payment, what you can actually afford versus what you could afford on paper 6 months ago or a year ago is drastically different. I think I saw something, I'm not really great with numbers, but if a person a year ago was able to qualify on paper for a $600,000 house, today they qualify for something ridiculous, like a $400,000.
400 and 450
right.
maybe.
And the issue with that, unfortunately, is that the prices that we're seeing on the MLS have not changed, but what someone can afford has changed. So hence the situation that we have today where there is a lot more inventory than there was at that point.
Correct. Still very low on a historical basis, though, in inventory.
Right.
Because one thing that I will say that they don't show you is when they show you those numbers, is houses that are already under contract. Typically, I mean, right now they came out of their report, CoreLogic, that we're sitting at about a 3.2 month supply of houses. When you strip out the houses that are already under contract, will all those close? You never know.
Well, and I guess that's a good thing if you're looking at, is the national market like a good place to invest in? So that's great. So will we experience? Are you thinking we're not going to experience the same kind of drop as other places in the country, or what do you mean by that?
I don't think Nashville. I think it's a little insulated compared to other markets.
Why is that?
Because we have so many huge companies moving here, and just so many people moving here daily. And you can go to Broadway Monday through Sunday and see all the people that want to come to Nashville. We have an amazing city that people want to travel to. It's a great vacation spot. So which is great, like you were talking about, for investors. You're an investor, you see it. A lot of people are trying to get Airbnbs here. Everybody wants to have their bachelorette parties here and everything else.
Right. So, well, let's bring this over to like just the normal buyer then.
Okay.
So the normal buyer is right now interest rates are would you say double than what they were a year ago?
They're double what they were at the beginning of the year.
Okay. So for a normal home buyer who's looking right now, let's talk about the pros and cons of a year ago and today. So obviously the big one is interest rates are much, much higher. What you can technically afford
Yes.
is less.
Yes.
So that's over here in the con. In the pros, I'll say as a real estate agent, if you were a normal buyer a year ago, like someone who needed to get an FHA loan, someone who needed the seller to pay for closing costs,
Right.
Someone who didn't have a boatload of cash, because we even had like our appraisal money over here. Like I don't like put as little down on the down payment as possible, so that we can have all this cash over here just in case your appraisal came back low from what you offered.
Yes.
Right. So we were needing to have. We were having real tough conversations with normal people on that is the current situation. And that was not a great situation back then,
No.
right? So like, even though technically you could afford to buy a house a year ago, the average person, the average family was in a really, really tough,
Yes.
challenging situation where they'd be putting in multiple offers at asking price, maybe a little bit above. For me, I know the majority of offers I had accepted, which I still stand by, were 10,000 over plus. Like going 5, 7, those things just didn't work out. You had to go above at least 10,000 or more in our market, and you still didn't know.
Yes.
You weren't able to do inspections. We weren't able to have anyone have the seller fix anything. So it was a very challenging environment now. And today, would you say this is a seller's market or a buyer's market in the national market right now?
If you're looking at inventory, by definition, it's still a seller's market. But I would say today's a buyer's market.
As I kind of almost think of it as nobody's market because, but it's always one or the other.
Right.
And if you've been an agent, especially a buyer's agent, you are just looking at all the houses that are staying on the market for a week, 2 weeks,
Right.
60 days. Well, maybe not 60 days, and you're just salivating because there's really options for your clients. Like
Right.
I've noticed, especially, I didn't want to go right into the investor side of this, but I'm really noticing it in the multifamily sector.
Right.
In your opinion, within the Nashville market, what is your prediction on housing prices and where that goes?
Do I think we're going to see 20%? No.
Increase?
No, definitely won't. Historically, from 1989 to 2019, the historic appreciation was 3.89%. That's not national. I'm not giving you Nashville's statistics. But I think Nashville's a better market than a lot of national markets. I mean, you can compare it to some of the biggest markets. And right now, with inventory still low, as long as builders aren't building that much right now either.
Right. They've slowed down. Some of them have slowed down
Yeah.
considerably. Yeah.
So
And some of them are freaking out, which I've noticed too. I think there's some at least on the under $700,000 range. And this isn't everybody. This is like a side note. I have noticed builders drop their sales price by like 10%.
Yes.
Just out the gate. And buyers, I was talking to another guy I respect in Nashville. He was saying, it's not like buyers are unqualified for that $700,000 house in Spring Hill. They're just looking. They're just watching. I wonder how low we can get it. Now they're just seeing some opportunity there, and I think there is opportunity on the new build side, because if I was a builder, I'd be kind of nervous.
Yeah.
Even in Nashville, I'd still be nervous, and which is interesting because in the last 2 years they were king of the hill. Like being a builder, like you do whatever you want, you pay your buyer's agent whatever you want, or don't pay them anything. Like they've got what everyone needs.
Yeah.
And just side note, how those builders treated people in that span is going to, I think, will be remembered. But anyway.
I mean, there's also a lot of other factors to consider. Economic factors such as how expensive commodities were last year. Look at lumber. I mean,
what is going on with? I don't follow.
Lumber's
Is it cheaper?
Oh, it's a lot cheaper.
Good.
I mean, it quadrupled last year, but now it's back down. But then, just like anything, it takes time for that to trickle down. You're just now being able to go to your Home Depot and Lowe's and get cheaper lumber.
Okay.
That's
good. So that kind of battles. When there's such a demand, though, COVID too. Everyone blamed everything on COVID, but when there's such a demand on lumber, why wouldn't they? They're building like crazy. Why wouldn't they just make it as they? I don't know who they is. But why wouldn't it just get more and more expensive? And now, if demand is seen to be going down, bringing those prices down makes
back
sense,
down.
right?
Yeah, I mean, going back to reality.
Yeah. So cool. All right. So did we finish talking about the two? So the 2-1 buy down. Can we just go summarize that real quick for a primary home buyer? So
I mean, to me, when I sit down with my clients, I go through, what are your goals? Like, how long do you see yourself in this house? No one right now is. Let me take that back. There are some people that are thinking the market's just going to go terrible, but I'm not one of those people. Like CoreLogic came out the other day, they're predicting year-on-year growth from right now to 2023, 3.2%. That's what they're predicting.
Up or down?
Up.
Okay.
So.
That's good.
Yeah.
Obviously, I was watching Channel 5 News, I just told you earlier, a couple nights ago, and they said I don't know who they're getting this number, but they were saying home prices down 20%.
And that's because they want, media.
There's something to talk about? Clickbait?
Headlines sell. Mm-hmm. But the data tells the real story. Mm-hmm. And if you look at the data, it's telling a different story.
Where do you get your data?
I look at the Federal Reserve side. I'm looking on Realtor, like NAR, a lot of different places. There's a lot of good sources out there. CoreLogic, what I'm talking about. Then, I don't use Zillow as a point, but they predict appreciation too. All these big companies, Redfin, CoreLogic, Zillow, not a one of them are predicting negative appreciation.
Really?
Really.
I'd love to see that. Okay, so in a nutshell, 2-1 buy down is a good option for primary home or secondary home, right? Right. So this is someone who's looking. If you're looking for a home for yourself, if you're looking to move out of the home you're at, rent that out, go to another primary, or have a secondary home, you can take advantage of the buyer's market that I'm saying we're in, comparatively to what we've been in in the last 6 months. Because I don't think you can have it both ways. You can't have lots of inventory compared to where you've had and still be in a market that's going red hot crazy. It's got to be a little bit tough for a seller comparatively, so that the buyer actually has opportunity.
So what I would say to that point is, like I said, it goes to your goals. Right now, if you're more concerned with your payment, because maybe you do have other debts, or right now it's just tight for you, then 2-1 buy down's perfect. But once again, depends on your opinion. If you think that rates will be lower, then 2-1 buy down's great. If you don't think that, because I just give people my opinion, the data, and then let them make their decision. I don't try to sway anyone. If you don't think that, then it might be better to lock in a permanent rate.
Well, here's the thing though. If it's gonna be higher, you don't get the rate of 3 years from now.
Right.
You're getting the rate of 3 years ago. So
Exactly.
if you think in the worst case scenario that rates are going to be 12% in 3 years, well, great, you're half that. At 7%, well, no,
Yeah,
it's not exactly
you summed it
half.
up perfectly right there.
Right. So, like, either way, you've got opportunity if they keep going up. The thing is, interest rates aren't like a stationary thing. They go up and they go down. You take advantage of the situation that you're in. Great. Thank you for that. Okay.
Yes.
On the investor side, which is something I'm interested in, some of my clients are interested in, I just wanted to just notate again, it's November 2022, and I found the best deal, and we've got one under contract that I've ever seen in the multifamily world. And
That's amazing.
the numbers make sense, which was blowing me away. The numbers make sense. It's a quadplex in the Nations. Of course, I haven't looked at it in person yet, but it'd have to be really, really horrible it would have to be very bad for me not to think this is a great deal.
I think we talked about this, and I said, really, in the Nations?
And I actually have
Yes.
it. We got it under contract somehow, and I'm very, very proud of it. So the deal was, this is an agent who's selling this quadplex in the Nations, this location. They had it listed for $650, and I can tell you, as someone who's looked very, very closely in this market for the last few years, even starting as a buyer to do like a house hack, this thing should have been listed even in this market at $850.
Right.
So, I'm not good with math. So what I'm interpreting with this, and after getting to know the agent a little bit, and hopefully we're closed before I put this out. Probably will be. What I'm interpreting with this is that, like, this is someone who's obviously been in the game for a long time. She's been around. She was doing real estate in 2008 when things went really, really south.
Right.
And I think there is opportunity in the investing world where people are offloading investment properties because they don't want the same thing that happened to them in 2008. So, like, she listed this thing so low, and there's tons of offers for it. And the psychology of that is, like, I think people looking at investment properties still want to underbid. Even when even in a case where you see something that is clearly listed for 15% less
Than market value. Yeah.
I mean, that's, if you're listing at market value right now, go 10% less to hedge for whatever happens to prices. But if someone's listing it low, you got to be ready to jump on that, and don't necessarily, whatever the price is, go less than that, because you're not going to get the house.
No.
And we were luckily we were able to take advantage of that, but the comps on this is absolutely ridiculous. So I think there's opportunity, even at an investor rate, which is going to be something like 8%. Even at 8% for this quadplex in the Nations, the mortgage is covered at current rents that she has in there today, which is unheard of.
Yeah.
And when we kind of work through the property, like today it works. Rents are going to go up. We're going to make, I think, $2,000 more per month on this property after we bring rents back up. So I've never seen a deal like that. They're out there right now, even at current interest rates. So I think that's on the investor side, because this 2-1 buy down is not an option for an investor.
No.
It's not meant to help investors. If you're an investor, they expect you to have some money, and they are trying to calm things down a little bit. So it's not the same frenzy. But if I've got a few clients right now that were investor types that have been on the sidelines because it's been very difficult to even to put in an offer that wasn't above asking. Like, no investor wants to do that.
Right.
And if you wanted to be in this market in the last 2 years, you had to. So investors don't typically like doing that.
Right.
But today, I think there's opportunity there, and I think you have to look at the multifamily world with people who are freaking out, because they think another 2008 is underway. And real quick, we have a couple minutes. Are you of the opinion that we are headed into a 2008 situation, or why is it different today?
Not at all. If you look at '08, once again, going back to the data, like I would tell people, I'm no expert, but go look at the data, don't read the headline. I mean, in '08, we were overbuilt. I mean, we had way too many homes and not enough buyers. I mean, right now, we still have a pretty good demand in Nashville right now. The thing right now is with the higher interest rates, some people cannot afford. Because the difference is home prices are still pretty high in Nashville. So with those higher interest rates, they might not qualify. But back then, we had way too many homes. Right now, we don't. We're still, that's why I said earlier, it depends on how you want to look at the market on it, if it's a buyer, seller's market, whatever.
I was really surprised that you said thought it was still a seller's market.
Oh, no, I think it's I agree with everything
the way
you
that
said.
It feels, but
Yeah.
no, that's a really good point. Like the inventory still shows that it's a seller's market.
Yeah.
Like if you look at it from far away,
Correct.
because I mean it was a seller's market even when I started buying, where houses were staying on the market for 30 days, 60 days. But back then in 2014, it didn't feel that way. Like it felt like it was normal for a house to be on the market for 30 days.
Right.
Right. And there was still a seller's market. Now we're seeing that today and we're like, Jesus,
Yeah.
what the heck's going on? Like, why is this house sitting here for 30 days? There's something wrong with it. They need to go 100,000 under asking. I'm not buying it. It's
People
just like
have
a different perspective.
I think people have short-term memory. Like they look at the past 2 years and that's all they can see. That's why I think right now, I think investors right now have an amazing opportunity because first of all, like you said, rent is going up. Rent right now in Nashville.
And that follows inflation, right?
Yeah.
So inflation goes up, what happens to rents?
It goes up.
Right.
Just like, so another thing.
Wait, if inflation goes up, what happens to home prices? They go up.
Yeah.
Everything goes up.
I mean, there's, once again, I would say go to the Federal Reserve site. So don't take my word for it. They have charts on this. Look at recessions. Home prices go up during this. And another chart that I love, if you compare rents, so when home prices surge, rent always follows, but it lags by about a year and a half. Because you got leases that got to run out before they can raise, those such things. But then rent goes with it. So that's why, housing is still a great investment. And to me, also, if you're an investor, you want to diversify. A home is an asset. It's not just where you live. You got an investor who looks at it as an asset. You got people who just live in a home, look at it as a home sometimes.
Right.
No, it's an asset that you can do a lot with. So right now, I mean, rent in Nashville is up 20% this year.
I think, well, I've talked about this. Anyone who's renting right now, I don't. I would think of that as 100% interest.
Oh, 100.
You know what I mean? So
yeah.
I don't think there's a scenario where renting. And I've seen people who actually think this way. Renting's a better situation for them.
Yeah.
Than owning your home and locking in the price,
Correct.
even if it's high right now. I've been here since 2014. Home prices every single time I bought were at the highest they've ever been at that point.
Mm-hmm. At that point.
And I always look a year behind and go, damn, that was a good deal.
Yeah.
I don't know what I'm going to say a year from now. It's very uncharted territory. So, I mean, I think there's opportunity. I think you also have to be smart.
Oh, yes.
And I think you have to work with some people that know what they're doing. So if you are in the Nashville market, I would definitely say hit Josh Jones up. Josh, thanks again for coming on. This was a little bit different than what we're used to doing. Hopefully it was beneficial to our viewers. How can people find you if they want to find you?
Find me on Google, Josh Jones, located in Mount Juliet, Tennessee at preferred rate. So.
Okay, perfect. Yeah. And we'll put that information on the YouTube channel. Thank you guys for watching again. If you want to contact me, you can get on the website dlgoodmanproperties.com. Thank you again for watching, and we'll see you soon.